Hey team, Nathan Watt from Watson and Watt. Today we're talking about the truth about tax planning, the cold hard truth. Is it my truth? Is it your truth? Is it your mate's accountant's truth? I don't know. Is it true that accountants have magic wands that we wave over the books and make your tax disappear? No. So there's a few things I want to run through, lots of misconceptions around how taxes work, how deductions work, how we can save tax, what does saving actually mean, and some trips and traps to watch out for. So let's get into it. So today, controversially, you don't want to pay less tax, and I'm going to expand on that in a minute. What does that mean? We're going to put tax in perspective, and we're going to look at how taxes work in 30 seconds so we don't get bored to death. And I'm going to elaborate on how most strategies don't actually save tax. And then I'll have some bonus stuff at the end there on some ideas for you. So let's have a look at it. Now, the first one is you don't want to pay less tax. You might say, that's rubbish, Nathan. Of course, I want to pay less tax. I would suggest that you actually want more cash. I don't pay my groceries with taxes. I pay my groceries with cash. If you have a look at this simple example here, an individual, you can either pay $0 tax or you can pay $55,000 tax. I know which one I want. I'm going to pay $55,000 of tax every day of the year if I can get $106,000 more cash in my pocket. Put it another way, if somebody offered you $1 million, but you have to pay $500,000 in tax, or they offered you $400,000, but you have to pay $100,000 in tax, I know which one I'm taking. I'm taking the $1 million every day of the week. I'm paying $500,000 in tax because I get more cash. It's as simple as that. So stop worrying about your taxes. Worry about what you're doing with your cash. Now let's put this tax in perspective. This is a business, sales $1 million, cost of goods sold $400,000, gross profit of $600,000, all the way down to a profit of $200,000, which is a 20% profit margin, which is pretty healthy. Now let's look at this. If it's in a company, small business company, it's going to pay tax at 25%. It's going to pay $50,000 worth of tax. If you're a sole trader, for whatever other reason, you've got tax at 47%, you'll pay tax at $94,000. But that's only 9% of your sales. So what are you doing with the other $906,000? That's the more important question. Can we save you some tax off 94? Maybe. You might get it down to 90, you might get it down to 80, I don't know. Is it going to be zero? No. Is it going to be half that? No. What you need to be looking at is where am I spending the other $906,000 in my life? And let's look at how we can change that stuff. And you'll get way more cash in your pocket because of the way the tax system works. So if you look at your taxes as just another expense of doing business and just another expense of your life, and you look at the percentage of it as it is of your revenue, it's actually not that big of a deal. The big deal is that people get surprised by it and they have to pay it in big lumpy amounts. And they're like, oh my God, I have to pay $50,000 worth of tax. I haven't saved for it. That is the problem. It's not the number of tax. It's that you haven't saved for it and that you've spent the tax money on something else. So, is my rant over? No. How does the tax system work? Same example as before. At the top there, you got income of $18,000 and $180,000. Contrasting the two, of course, you get more cash if you earn $180,000 than if you earn $18,000. Way more. So what is actually income? Well, that's a long, boring story. So let's just call it your revenue. And what are expenses? Well, they're called tax deductions, but that's another long, boring story. So essentially, it's your income less your expenses equals your profit. And you can think of that as your taxable income. Is that 100% right? Am I oversimplifying it? Yes, but just think of it like that, and we'll get through this a little bit easier. So your profit is what you pay tax on. If you spent $18,000 of revenue and you spent $10,000 on stuff, you have a taxable income of $8,000. You don't pay tax on $8,000 as an individual, which means you have after-tax cash of $8,000. Not a lot of money to live on. Contrast that to someone who's got $180,000 of income and they've got $10,000 of expenses. They have $170,000 left over. They pay $51,367 of tax, the current tax rates, which is less than up here. But it's not $10,000 less, is it? It's only $3,900 less. Why? One, because we have a marginal tax rate system, so it's not dollar for dollar. You don't spend $10,000 and the tax office does not give you $10,000 back. That's not how it works. Your deductions are only as good as your tax rate. In this case, the average tax rate is $3,900 or 39% because of the way the tax system works. So out of pocket, what's happened here? That $10,000 for this person has cost them $10,000. For this person, it's only cost them $6,100 because the taxman is going to reduce their bill by $3,900. Nice. You still have way more cash up here, but you haven't saved any tax. So your $10,000 is only cost you $6,100, but you're still out of pocket $6,100. So if you don't need to spend the $10,000, don't spend it because you can't spend your way out of a tax bill. So, do companies save you tax? Kind of, no. They actually defer tax. So let's have a look at this again. A sole trader makes $180,000 of income. This is ABN in their own name. They've started doing something, selling widgets, and they pay tax at their marginal tax rate. They have after-tax cash of $124,000, and they go and live their life and buy groceries and beer and Skittles and all sorts of stuff. Cool. There's no additional taxes because the sole trader is the same person as an individual from a tax and legal standpoint. Now, if this business was in a company, a proprietary limited company, had $180,000 worth of profit, it would pay tax of $45,000, which is 25%. And hey, look at that, we've saved $10,267 of tax. We are so smart, you should pay us lots of money because we're the best accountants ever. But you, as an individual, still need to buy beer and Skittles, so how are you going to do that if you leave it all in the company? Well, you need to pay a dividend, or you need to pay wages. And I've used the dividend example because it makes these calculations easier and I can cut and paste. But the important point is, whether it's salaries or wages or dividends, it doesn't matter because the end result for tax purposes is the same. So you have $135,000 after your tax bill in your company, you rip all that out to go and buy beer and Skittles. In your personal tax return, you get a $135,000 dividend, and then we add on the tax that the company has already paid. Now that might seem a little bit weird. You get this taxable income of $180,000, but if we look up here, that's the same amount up there, right? So it's putting the shareholder in the same position as the company was. We then apply the shareholder's tax rate, which is the marginal tax rate. It's 55,267, and then you get a credit for the tax the company's already paid, which means Mr. and Mrs. Shareholder has to pay $10,267 out of the $135,000 worth of cash they've already received. So look at that. The tax is exactly the same. It's just whose pocket who's paid it. In this one, the company paid $45,000 and the individual paid the other $10,000. In this one, the individual just paid it all. It doesn't matter. It's the same amount of tax. So a company will only defer tax if you don't pull the cash out. So if you leave the cash and the profit in the company, you go and buy more stock, more equipment, invest in all that sort of stuff, great, build the business up, all works out well. When you shut that business down, when you sell it, when you die, whoever's left over needs to get these retained profits, which is what this is, the accumulation of all your profits over time. That needs to come out of the company at some stage. So somebody is going to pay the piper and somebody is going to have this calculation into their tax return. So at best, you're deferring tax and you're making it somebody else's problem. Now, most strategies don't save tax. A lot of the stuff getting peddled around is, we've saved this person X amount of dollars. Is that true? Maybe. It might have saved it this year. Did it save it for next year? Or did it just bring it forward or kick the can down the road? I don't think deferring tax is actually saving tax. It's just creating a problem for tomorrow. And a lot of the time it does more harm than good, because if you don't have the cash to pay your tax bill today, how are you going to have the cash to pay the last year's tax bill tomorrow plus tomorrow's tax bill tomorrow? It doesn't work out a lot of the time. So, yeah. So deferrals, what do I mean by that? So as I was talking about in the company, you might save some tax now by having in a company only paying 25% tax, but eventually when you get that cash out of the company, you're going to pay your marginal tax rate. If you're running your business in a trust and your accountant says, hey, let's distribute that to a bucket company or a corporate beneficiary, it'll pay tax at 30%, and we've saved all this tax, and we're so smart. What they're not telling you is that that bucket company, if you want to get the cash out of that company, you need to pay your marginal tax rate. If you don't transfer the cash from the trust to the company, then you're going to get caught by something called Division 7A loans, which is a whole other video, but essentially you need to pay that money back to the company. If your accountant says, hey, we'll just set up this loan account, so rather than paying you wages or a dividend, we'll just put it as a loan account, and then we'll just sort it out next year. That isn't making your tax bill go away. That's just putting your head in the sand and deferring it until next year, when you probably have already spent all the money and don't have the cash to pay the taxes. So instant asset write-offs, the government of the time will always try and spruik this as some great big wonderful thing, when all they're really doing is giving you the same tax deduction in this year as you would have got over the next couple of years. So if you buy a car this year, you get to write off, for tax purposes, the cost of it up to the car limit. You would have got to do that anyway over 8 years. So you're getting it this year, which bird in the hand, yeah, that's cool, but it's not actually saving you any more additional tax than you would have already got back. Prepayments, again, timing issue. You can prepay your interest, prepay your rent, prepay your insurance, all that sort of stuff. You bring the tax deduction into this year, it just means you don't have it next year, unless you prepay next year's as well. So can they be effective? Can they save some tax? Yeah. If you've got heaps of tax this year and you've got a high marginal tax rate, and you're not going to have much next year, then yeah, you could save some tax by doing that. Is it really going to make your tax bill go to zero? Probably not. Most of the time, it's just sort of playing around the edges, and it's not really a net benefit. If you're going to incur the expense in the next 30, 60 days after the end of the financial year, and you could just do it now and save it this year, yeah, sure. Bring forward the tax deduction by 12 months and the tax saving by 12 months. That makes sense. But it's not, at the end of the day, it's not saving you any more than you would have already got. So can we actually save tax? In the accounting lingo, it's called a permanent difference. So is there a way that we can actually pay less tax and there's no kicking the can down the road, there's no catch up at some later time? Yes, we can, but they're very limited in number. For most purposes, things like extra superannuation contributions, your wages will have 10% super on it. You can kick that up to the maximum amount, which is currently $27,500. So yeah, if you're paying tax at 47% and you put money into super, your super fund only pays 15%. You can save, a bunch of tax on that. There's some conditions on that one. So if you're a high income earner, that's not quite the story, but for most people that works. Of course, you're locking away all of that cash into superannuation until you reach your preservation age, also known as retirement. So if you're 45 and you're putting in 20 grand extra into super, you're not going to see that 20 grand until you're 65 or at 60 at the earliest. So yeah, it saves you some tax. If you can afford it, then it makes sense, or it might not make sense. It's up to you. But super can definitely be a permanent difference. Some salary sacrifice arrangements can save you some money. Things on like cars, stuff like that. Is it going to materially change your tax position? No. Will it save you a couple of grand a year? Yeah, sure. Exempt fringe benefits, again, not going to change the world in total. It's just a couple of $100 to a couple of $1,000 a year that, yeah, you could save some money doing those. And they're things like paying for lunches at work. So business puts on lunch at work in the office on a work day. That's not a fringe benefit. And it's tax deductible to the company, so all well and good. As I said, they're not really huge amounts of money that are permanent differences like that. So some other ideas for you, rather than worrying about how much tax you're paying. I think the issue is you don't know when you're paying your tax or how much it's going to be, and you're getting surprised. So what you need to do is plan your tax payments. So this is a known. We know when taxes are due. We know when BASs are due. We know when all that stuff is due, and we know how to calculate tax. So we can then, just using a little bit of brain cells, put together a plan that says, okay, in these months, I'm going to pay roughly this much money on my BAS, on my tax instalment notice. And we're having a cracker of a year, so those instalments aren't going to be enough to cover our tax bill. We're going to have a catch-up tax bill in May in 2 years' time. We know how to do that. Accountants know how to do that. It can be mapped out. It should be mapped out. And then every month, every invoice, every time you get paid, you're transferring a certain percentage of that cash into separate bank accounts. You have a bank account for your GST, have a bank account for your income tax, have a bank account for super, have a bank account for wages, have a bank account for supplies. You could have as many bank accounts as you want if you need to do it to make your cash flow and your provisioning better. And I have clients that do it, they do it well, and they know exactly what they can spend and what's theirs to keep. And the rest of it, they don't think about it. I personally do it for my own business, transfer money into the savings account. That adds up to my super, my PAYG, the GST. At all times, there's that much cash sitting in there. And I know it's not mine, I'm just holding it. Burns a hole in my pocket, and I hate it, but I know that it's not mine and I'm not going to spend it. As I said, salary sacrifice does work. Small things, cars, super, work-related items, laptops, tablets, all that sort of stuff can be made cheaper by salary sacrificing effectively. If you do it wrong, it doesn't make it cheaper, it makes it more expensive. So be really careful how you do that. Get some advice about it. But yeah, it's not going to change your life by saving a few grand off that sort of stuff. There's one that's out, or has been out for a couple of years now. It's getting some traction. There's up to 5 years of unused concessional superannuation caps that can be contributed to. This started in the 2019 year, so we're only 3 years into it. So the 5 years won't be for another 2 years, but essentially if you've only been putting in less than your concessional contributions to superannuation, you can catch those amounts up so they're not lost. Conditions do apply on that, depending on how much you've got into superannuation. So talk to your advisors about whether that's appropriate and whether or not you want to do that. But there is some scope there to get some more money into superannuation if that is right for you. So a longish video on the truth of tax planning, probably bursting some bubbles, my cynical view of how things work, but taxes and death, the two certainties in life. So be prepared that your tax bill is not going to be zero. The only way it's going to be zero is if, one, you have all your money in superannuation and you're getting a pension from your super fund, and that balance is less than $1.6 million, or you're earning less than $20,000 or thereabouts in your personal name, which, if that's the case, hopefully you've got money in superannuation, which is exempt. Or you're losing money in your business. You're not paying any income tax because you're making a loss. So you're having to fund 100% of the loss, and that's not sustainable. So you need to do something about that. So you're going to pay some tax. The important thing is what you're doing with the after-tax cash amount and how you can increase that rather than wiping out your tax bill. Can you save a few grand? Yeah, maybe. Can you make it go away completely? Absolutely not. So, yeah, all the best.